Could a strike near Iran's main oil hub shake your portfolio this week? Here's what investors need to know to navigate energy risk without overreacting. Former President Donald Trump said he ordered U.S. strikes on military targets on Iran's Kharg Island while avoiding oil facilities. Kharg Island is the core export terminal for Iranian crude. Even rumors of disruption here can move prices and sentiment. The initial statement did not include timing or Pentagon confirmation, so traders are weighing headlines against fundamentals. Why does this location matter so much? Oil flows hinge on safe loading, insured shipping, and predictable transit. When military activity touches a critical node, perceived risk rises. Insurance premia can creep up. Charter rates can adjust. Futures curves can price a higher probability of supply hiccups, even if barrels keep moving. For inflation and rates, the channel is straightforward. Higher crude can pass through to transport, chemicals, and goods prices. If markets judge export capacity as intact, the price impact may be contained. But uncertainty alone can lift volatility, complicating central bank paths and nudging yields higher as traders reassess rate cut odds. Equities sort into potential winners and laggards. Energy producers and some oil field services names tend to benefit from firmer prices and wider cash flow. Midstream exposure can be supportive if volumes and tariffs hold. On the other side, airlines, logistics, and energy-intensive manufacturers may face margin pressure if fuel surcharges lag spot moves. Rate-sensitive growth stocks can wobble if bond yields climb on inflation anxiety. Currency markets and commodities often echo the same theme. A risk-off tilt can support the dollar, pressure emerging market FX, and add chop to metals. Short-dated oil options may see implied volatility spike as traders hedge headline risk. So how do you position without guessing headlines? Focus on scenario bands instead of single outcomes. Stress test your portfolio for a moderate oil pop and a volatility jump. Revisit exposure to sectors sensitive to fuel costs and to duration if yields back up. Consider staggered entries and defined risk in any energy tilt, and avoid chasing intraday spikes. Most important, separate temporary headline risk from sustained supply loss. Watch verified flow data, insurance conditions, and shipping activity around Kharg. If barrels keep loading and sailing, price spikes may fade. If operations slow, the impact broadens from commodities to rates and equities. Read the full article at finlitica.com.